Hey, everybody, Joshua Phillips here with Churchill Mortgage, and I'm a part of the Phillips team. You may be working with Amy, you may be working with Jesse. As I always like to say, if you're working with a Phillips here at Churchill Mortgage, you're in great hands. We're going to take great care of you. Well, it's May the 15th. Let me start with some good news first. Good news. It's beautiful outside. You are alive if you're watching this, and God is still good. So let's start with that. Now, let's move on to the bad news. Boy, it has not been a good few weeks here for mortgage rates. And the reality is, I got to give you the real. I'd love to hype it up and talk about how great rates are, but it has not been a good 2 or 3 months, really, to be honest with you. So let's look at a couple of headlines on CNBC. Let's start with this one. Inflation rate projected to hit 6% in the second quarter, topping economic forecasts. So we're starting to get updated economic news now that we've gotten a little further past the Iran war starting and gas prices going up and other things going up. And we are starting to see that inflation. Now, if you look back to the last couple of years, when you hear the word inflation, that is not what you want to hear for mortgage rates. So now, let's move on to the second headline. Because of that, also today on CNBC, it is saying traders now see the Fed's next interest rate move as a hike. Holy cow. Oh, man. Wasn't this supposed to be the year that we got the more Fed cuts? But no, it is starting to look like we may actually get the next move for the Fed may be a rate hike. Now, the Fed fund rate and mortgage rates are different, so it's not the same thing. They don't always move the same direction, but I think this is an indicator that we are not going to see low. Let's just say this. We're probably not going to see rates lower for a little while, and we need to get used to where rates are today. So, one more place here. Sorry, this is like just bad screen after bad screen, but again, want to keep it real with you. So as we always show, this is mortgage-backed securities, and this is a Japanese candlestick chart. All you really need to know to understand this, as always, is that green is good, red is bad, and the higher the security price, the better mortgage rates are doing. So we want to see green, and we want to see on the chart things going higher. So let's take a look here where we are. And you're seeing a lot of red candles, especially the last 30 days. The last 30 days have not been good for mortgage rates. And so we are now today, you see a big red candle and a big gap there here at the end. All you need to know is that that's not good for mortgage rates. And we are back right around the highest levels we saw back a couple months ago. Let's zoom out a little bit further. Let's get a little more perspective here. So this is a 1-year chart of mortgage-backed securities, and we saw things getting better and better. We came into 2026 with mortgage rates kind of hovering around the best levels we'd seen in 3 or 4 years. And then, of course, the Iran war. And since then, we started beginning in March, we saw rates rise. Then we saw a nice bounce back. I mean, if you got into a rate lock mid-April, you actually did pretty good. Since then, we have fallen back off, and we're kind of regressing back to where we were like last summer with mortgage rates. Now, without getting any specific rates, I would say on 30-year, we're going to be solidly in the 6s now, and I think everybody's got to get used to something with a 6, unless maybe doing a 15-year or unless you're buying a couple points on a government loan potentially. But for the most part, we're going to be seeing rates solidly in the 6s, and I hate to say it, I think we're probably going to be seeing that for at least the rest of the summer. So not holding out huge hope that we're going to see rates improve. In fact, they may get worse before they get better. Now, for some perspective, you got to remember that the average interest rate over the last 30 years, about as long as I've been doing loans, is about 6%. So rates are still about average. The good news is, if you are out there looking, this is going to put a lot of people on the sidelines. A lot of people are like, I'm not going to buy right now. So I will say it's going to be a buyer's market for the summer. I think it's going to be a buyer's market, meaning that if you are a buyer, you may have more leverage, more power to negotiate for closing costs for a lower price. So in some sense, there's some positives that come out of this. Of course, if you have a house to sell and a house to buy, it cuts both ways. You may struggle to sell and not get what you want, but then you may get a better deal on the purchase. So that may just kind of balance out for you. Well, hey, it is what it is. We are still seeing people purchasing homes. If you're looking to refinance, there are some scenarios where it still works, but if you're purely just trying to improve your interest rate, you're probably going to be sitting there for a little while before it makes sense, just purely from a rate improvement standpoint. Now, if you need cash out or you need a HELOC or some other structure, maybe you are shortening your term down to 15-year, there could be some value in refinancing, and we're always happy to have that conversation. So let us know how we can help you. If you need to get pre-approved, if you need to talk about numbers for a particular house that you're interested in, we are here to help you. Hey, have a beautiful weekend. It is a great time of year, and there are other things to be happy about other than mortgage rates. So, all right, take care. Bye-bye.